We just bought a stock and invested our hard-earned money. What should we do next? Do we simply just wait until it's 2 cents or $5 higher and then we sell? In this video, we're going to talk about what to do after buying and investing in stocks. Before we buy something, we do tons of research, comparing similar products and doing pros and cons, making sure that the products and services that we bought will return the value of our purchase and investment. The same thing with stocks. We do a lot of research to understand how will these investments produce profit and return on investments. But what we do after is of the same importance. The first thing that we should do after we buy a stock is to not sell. Warren Buffett said you should not hold a stock for 10 minutes if you don't intend to hold it for 10 years. We can also take it as you should not hold a stock short term if you're not willing to hold it long term. For beginner investors, this means that after buying a stock, you should move on and stop looking at the price changes. More money is created holding the stocks long term compared to selling them and taking your $5 or $10 profit. But Ron, I could just sell and take my profits and buy back again. That'll be a great discussion in the comments down below. Please let me know your thoughts, and that topic deserves its own video. But a quick take is taxes and fees. These will take a toll on your portfolio if you do this long term, and you will miss the benefits of a long-term investments like lower taxes on qualified dividends. How will your business grow if you sell your business the moment you earn some profit? Let me ask you a question. Where do you think our money goes when we buy a stock? Before investors like us can buy a stock of a company, the company has to go through a process called IPO, or initial public offering. This is where companies hire investment banks to do marketing, gauge the demand, set the IPO price and date, and a way more complicated process to pass the requirements of the exchanges like NASDAQ and the Securities and Exchange Commission, or SEC. Long story short, this is the first time they get offered to the public financial market, or the stock market. When you buy a stock on an IPO, your money actually goes to the company and becomes part of their capital. When you're not buying on an IPO, you are actually buying in secondary markets. Investors like you and me buy and sell the stocks with each other. The money that you paid to buy the stock will not go to the company, but to the person or entity you bought the stock from. Now that we know who gets the money when we buy a stock, let's understand what is this thing that we just bought. A stock is a representation of ownership of a business. So if we buy a stock of Starbucks, we are considered an owner. In this case, we are a part owner depending on how many stocks do we have. So I can go in Starbucks and show them that I am a stockholder and get free coffee? No. Starbucks has more than 6 million shares. Imagine if every stockholder asked for a free coffee. Definitely Starbucks will take a huge loss in their revenue, and since revenue is one of the drivers of the stock price, the loss from the discount would mean a huge drop in stock price. So no free coffee. And don't take that chair. Even if you're a shareholder, that is a company property. What you will get with the ownership of a stock is the ability to participate in the company's profitability. This means you get to earn dividends. If the company is a dividend-paying company, as a shareholder, you are entitled to dividends. You also get to enjoy capital appreciation as the company consistently grows its revenue and profit. As a shareholder, your investment grows, and of course, a loss is also a possibility. You also get a chance to exercise your voting rights. You get to vote and elect the directors of the board, mergers and acquisition, and more. Now, with all these things that we get to enjoy once we became a stockholder, we also need to do things on our end to make sure that our investments are on the right track. If you're getting value in this video and you start to understand more of what being a shareholder means, don't forget to give this video a like and make sure to subscribe to get more videos like this. We talked about the first one earlier, which is to not sell. Now the second action that we should do after owning a stock is to be aware of what's happening inside the company. Reading news articles about the business, watching and reading content, and understanding about what's happening inside the company that could impact its profitability. News like business acquisition, stock offerings, dividend increase, and special dividends are some of the business updates that a shareholder should be aware of. These updates fuel short-term volatility in the market. Depending on your portfolio, this could give an indication to take profit or increase your position. Paying attention to the company earnings is also part of being an investor. This is when companies report publicly what is the status of the latest quarterly earnings. The company will report its EPS, or earnings per share, and the quarterly revenue. They will also announce their guidance and estimates for the upcoming quarter. Let's quickly define these terms. Starting with the EPS, it is the net profit divided by the number of outstanding shares, and the EPS can be a beat or a miss compared to the previous guidance and estimates of the company. Guidance, estimates, and forecasts are a set of expectations that a company is anticipating with the upcoming quarter. In this example, Netflix shows their expectations and some factors that might affect the target EPS and revenue. Talking about revenue, it is also compared to the previous estimates to see if the company made more sales compared to the previous quarter. You should also never forget about reinvestment and replacement. A seed have more or less 50% chance of growing when you plant it. We can increase this chance by watering and taking care of it. The same thing can be said for our investment. If we just invest initially, yes, it will grow, but it will not be as profitable if we don't consistently increase and reinvest. Let's say we invest $1,000 and bought an S&P 500 index fund or an ETF like VOO with an estimated annual growth of 10% after 30 years. 30 years? Yes. 30 years. Without an additional investment, we will have $70,400. Now, if we just add $100 every year within that 30 years, we can easily double our future returns. One of the misconceptions is that investors only need to put an initial investment and it will provide a quick return and even double our money. In reality, it takes time before you see a significant return. If you want to speed up that time, reinvesting consistently will definitely give that investment seed a boost. Sometimes, business shifts its focus, and it might be that they change their business strategy. These affect the stock on our investment, giving a positive or a negative impact on our investment return. If it's a negative impact and the business doesn't fit our investment thesis anymore, replacing the business or the stock might be necessary. It doesn't mean that every time the stock price goes down, you will sell or replace the business. What we're talking about here is the long-term impact and business changes, not the stock price volatility. After buying a stock, setting your goal to earn consistent dividend is one of the best ways to build and start your investment snowball effect. One of the first milestones that will significantly improve your portfolio is to earn your first $100 dividends. And in this video, we talk about how much money you need and how much time it will take to earn your first $100 dividends. And I showed a real life example on how I earned my first $100 dividends.